So for this video, I wanted to talk about external range liquidity, and this is a concept my mentor actually taught me. But essentially, what it is I've previously touched upon liquidity and what it is, and I've told you like it's literally money in the form of buy stops, sell limits, buy limits, uh, orders that have already been triggered, orders that are yet to be triggered, and what I want to do is show you. So when you enter a trade, so let's just say for example, price is now downtrending, right? And you have your point of interest at some point in the past, and your price comes back up and breaks the last point of structure here, right? So price comes up and breaks that last point of structure. So just price breaks this last point of structure. What you want to do is understand that anything outside of this price leg here, anything outside of this price leg here will be considered external range liquidity. Any form of any structure outside of this price leg will be considered external range liquidity. And that's because it's so external obviously means outside, and range is like an area, and liquidity is obviously that I've told you what liquidity is. So what you want to understand is that when you take your positions, the same sorry, let me just close this. The same technique, the same strategy, the same concepts you apply to your entries should be the same concepts, strategies, and techniques you apply for your take profits. And what I mean by that is, let's say you enter at this inefficiency here, yeah? So price is now trending back down, right? It taps your inefficiency and you take your position. And now you're like, oh well, where do I put my take profit? Where do I know to set my take profit level? How do I know when to get out? So external range liquidity allows you to identify that. So when price trends back up, you can take your profit when price breaks this last point of structure here now, right? That's your, because anyone who was to be selling up here, they have their liquidity up here, and that's outside this range. So it will be liquidity resting above here. So that will be considered external range liquidity. So if you're buying, for example, let's say you bought here. Oh, come on. Let's say you bought here at this inefficiency, right? Your take profit should be at the last point of structure here, because what? Liquidity is resting above that point of structure. So you want to set your take profit there, and what you'll see price do is, even if you don't have a clear break of structure and candle closes above, 9 times out of 10 it will purge and reverse. So it will spike your take profit and it will reverse. And that's completely fine, because you've taken your profit. You've taken a successful trade. What more do you want, right? And what I mean when I say the same techniques and strategies that I'll teach you for your entries should be the same you apply for your take profit is that, let's say for example, within this price leg we had an inefficiency here. Why not, if you know that at every inefficiency there's going to be some form of a reaction, why not set your take profit or take partials at that inefficiency? You know there's going to be a form of rejection. Price will be magnetized towards the region, so put your take profit there and then let the rest run. Take more partials when you break the structure here, and same applies to previous points of structure here. So this will be a last point of structure up here, and this will be a last point of structure up here. So these are all areas that you should feel more than happy to take your profit at. This is the last point of structure, it's the last point of structure, and like here, you have liquidity. You have liquidity here. Why? Because those who manage to sell have their stop losses up here. That's their capital, that's their money, right? Here. Whoever was selling up here, they have their stop losses up here. So when price is now going to trend, right? So you took your entry, price is now going to go up. You've taken partials at the inefficiency. You'll take it at this last point of structure here. Or if we have a nice break of structure, you take your profit when price goes back up and breaks this point of structure, acquiring that liquidity. Does that make sense? That is how you set your take profit level. And the same goes for like a sponsored candle, for example. If there's a sponsored candle somewhere up here, if there's a sponsored candle, for example, here, right? Put your take profit at the sponsored candle. That way, you don't even need to wait for price to break the structure. You've taken your profit before price has even done that. You've taken 50% of your trade off before price has broken that point of structure. Do you understand that? And let me just quickly show you this on a real chart. So let's just say, for example, we look at, let's zoom out to the 15, right? So let's say that let's say, right, let's look here. This is our range here. From this high to this low, this is our range. Anything outside of this leg is considered external range liquidity, right? So, for example, if we look back, price was uptrending. These are all, for example, here, last point of structure, right? Here, structure. Let me just do this for you quick. Here, again, structure. And again, here, right? That is how you learn to take your profits. So let's say you decided to price came back up. Let's just say there was an inefficiency here somewhere, right? And you decided to short. Oh, sorry, this doesn't make sense. Let's say, sorry. Let's say this was your range. My bad. Let's say this was your range here, right? This was your range. Price came back up, tapped your inefficiency, and now you're looking for your take profit, right? Anything outside this range is considered external range liquidity. So let's just let me show you on the replay, for example. So like I showed you before in the illustration, these are all last points of structures here. That was a last point of structure, last point of structure, last point of structure. So you take your short position at the inefficiency, right? Let's say you take it at the 50. You got a nice 5 pip stop loss. You can take your first profit when price breaks this last point of structure here. See, you see here, price came extremely close. Price actually came 1.4 pips from purging that low, but it didn't. So let's say you took that short. You can set your take, or not your take profit, you can set to take partial profits at 62 pips. And even if you take full profit, you are guaranteeing yourself 11%. You could take this one trade and be done for the week, right? So let's say you take your first profit here, right? So this is how you do it. Let's just remove all of these, right? This should be here. should be take profit 1, right? Take profit 2, take profit 3. Right? And what you tend to see price do is spike, spike, spike. Do you see that? So by understanding these last points of structures, and that there were people there were retail traders who were buying here, right? So their stop loss is like, even if they have a 10 pip stop, their stop loss has been spiked. Do you see that? They've been stopped out. They're no longer in the trade. Their liquidity, their capital has been purged. And you use that to your advantage. You understand how price maneuvers to acquire liquidity, and you set your take profit at these levels. Let's say you completely ignore TP2 and TP1, right? And you just go straight for your last take profit. You're acquiring 109 pips, and that's 20%. You're guaranteeing yourself that move. You're guaranteeing yourself healthy profits. However, I highly advise taking profit at your first take profit. At your first last point of support, I highly recommend taking 50% off, like I explained in the previous video, for your I believe it was the market structure, or was it the I think it was the risk management one. Yeah, it was the risk management video. If you go back and watch that video, I talk about how when price breaks the structure and it acquires the last point of structure here, take your profit, because even if price returns against you, you've managed to bag. Let's say you take 50% off. You've taken 6%. You've taken 5%. That's good. That's good. And even if price does return against you, your your strategy, your plan has catered for you to take profit and put your position into risk free. So let's say you risk free your position and price returns against you, you've taken 6%. And in this case it didn't. So you let the rest of the trade run, and you would have bagged yourself what, 15, 16, 17%. That's how you use the same. And if, for example, here you could have taken your profit at this candle here. This is what I mean when I say you use the same entry and techniques for your entries as you do for your take profit. You could have had your take profit at this level here, at this candle. Again, the techniques and strategies you use for your entries should be the same you use for your take profits. Now, I highly recommend going back into the charts, and even if you're trading on a demo account, use this strategy, use this method. It will give you more confidence in your trade. It will give you more clarity when you're trying to take your profit and trying to identify, okay, I've now entered, these are the areas I'm going to exit. Always have an exit strategy. It's most important. Besides that, thank you guys for listening, and on to the next.